Here are my top 4 dividend stocks for you to consider for May 2023. Let's talk about the qualifications first. Number 1, they must have a dividend yield of 4% or greater. We're not talking about any of these 3%, 2%ers. 4% or higher, it's an absolute must. And number 2, they must have at least 6 years of dividend growth and consistent dividend payouts. You know, it's easy to chase high yields, but we want good quality growth stocks that can continue to pay that dividend in the long haul, not just a fly-by-night, here's a big dividend, and then like next month I'm going to fall and crater down to the ground. We want something of consistency. Now, today's list involves both normal stocks, normal companies. I don't even know if normal is the right word, but that's what I'm going to say. Normal stocks and real estate investment trust, REITs. If you don't know what that means, I'll explain it as we go through the video. Let's talk about the first stock on the list, and that is FRT, Federal Realty Investment Trust. This company focuses on ownership, operation, and redevelopment of high-quality retail-based properties located in major coastal markets from Washington, D.C. to Boston, San Francisco, and Los Angeles. The goal is to deliver sustainable growth through investing in communities where retail demand exceeds supply. Look, people want to shop. And if they are trying to shop and there's not enough availability, there's too much demand, not enough supply. So this company is trying to increase that so that way they can take advantage of all the profits that are potentially being left on the table. Could this be a good one for us as dividend investors? Let's dig in. Here we are on my favorite investing research tool, Seeking Alpha, and here we are on FRT. You can see the forward dividend yield of 4.44% as of the recording of this video, so it does meet qualification number 1. And its last dividend, which we can find on the dividend tab right here, we're going to scroll to the bottom, was $1.08 per share. Now that does pay quarterly, but $1.08 is pretty good, and it was paid out on 4/17/2023. Now this company is considered a REIT. And because it's a REIT, there's a requirement that they must pay out at least 90% of their profits. That's what the payout ratio indicates. So this one obviously is exceeding that at 161.96%. But the cool thing about it is FRT has consistently paid their dividend and continued to grow their dividend for the last 54 years. So nice. Longer years of dividend growth and dividend consistency, especially during like downturns, like we're talking about the financial crisis of 08-09, we're talking about the pandemic, which really impacted a lot of retail stores. The fact that they were able to continue to set a goal and continue to deliver on that goal of a consistent dividend, that shows you the strength of a company. But it doesn't stop there. You got to look under the hood. So what I recommend you do in each one of these companies is to continue to keep your eye on their financials, not just in your research, but also in the future. If you decide to ever become an owner of any type of stock, REIT, ETF, does not matter what, always dig in and keep your eye on the game. Because as an investor, you're an owner, and you, as an owner, you want to make sure your business is doing what you expect it to do. So on this particular tab on financials, we want to make sure, is the revenue continuing to grow? And in this case, you can see it sure is. And sure, we did have a dip in 2020, but I always give 2020 a pass. If you look at the overall growth, take a look at that. From the year of 2013 all the way forward to 2022, we do see total revenues growing and going up. We also see operating income going up, and that pulls down some of the expenses too. So that's a good thing to see. You can hop over to the cash flow, see that their net income is looking strong, as well as their cash from operations. So that's the first one on the list to consider. Let's move on to number 2, which is Manulife Financial, ticker symbol MFC. This stock is a financial company with a payout ratio of 41%, which is great because this is not a REIT, this is a financial company. It does have 9 years of dividend growth and 22 years of consecutive dividend payouts. The forward yield on Manulife, as you see here on Seeking Alpha, a nice 5.29%, and the price isn't bad at $19.41 per share. Let's hop over to their dividends tab and see what they got rocking over here. In the last quarter, they're another quarterly paying. They paid an amount of 27 cents per share with a payout date of 3/20. By the way, a lot of people get confused by this. 27 cents, they think, well, that's not as much as the prior one. But remember, we're talking about the yield. This yield is pretty high. The 5.29%, remember, it only goes right now on the recording of this video for $19.41 a share. So that's a good payout ratio. Even though it looks like it's smaller, you get more bang for your buck in this case because it's a 5.29% versus the yield of FRT, which was at 4.44%. That's what you got to also keep your eye on. You could have two companies with the same exact dividend percentage yield, but one will pay more dividends either monthly or quarterly, whatever their payout schedule is, more than the other one if their stock prices are significantly different. So always keep that in mind. Let's take a look over here at their total revenue. You can see they're making a decent amount of money. There is some weirdness going on right here. As an investor in 2022, I want to make sure I understand what's going on with the sudden decline in revenues. That's something that we want to keep an eye on. Sure, the dividend might be great, but we also want to make sure this is a stable company long term. But this one could be a good one to look into because it does have a high dividend yield and it does pay consistent dividends. Let's move on to number 3 on the list. Number 3 on the list, Getty Realty Corp, GTY, a nice 5.11% dividend yield, and it's our second REIT on today's list. Well, Getty focuses on, convenience stores, gasoline stations. You probably have seen one of these as you drove around, if they're available in your state or local area. If you have, comment down below. Getty is one that is well known, it's been around for a long time, and it's a pretty decent gas station. And what's interesting is as of September of 2020, the company has owned a remarkable 896 properties and also leases 58 properties from third-party landlords in 35 states across the United States. And it has had 9 years of both dividend growth and consecutive dividend payouts. Checking out right here on Seeking Alpha, their last payout of 43 cents. They pay quarterly as well. Looking at their financials tab, we can see that their total revenue looking okay. You can see a consistent growth over the years from 2013 up to 2022. And yes, they were even able to increase their revenue during the pandemic. Hopping over to the cash flow, net income is looking good as well. And again, there's a lot more things that I look at. So if you're interested in learning more, make sure you stay tuned for more personal finance videos. But this is another one for May that you can keep your eye on. Let's move on to the final one on the list for our dividends for May of 2023, and that is Duke Energy Corporation. Now, Duke Energy is just like it implies in its name. It's an energy company focused on providing power and electric utilities. They offer a nice 4.12% dividend, and they've paid consistent dividends over the last 16 years. And they've grown their dividend payout over the last 11 years. This is not a REIT, but their payout ratio is pretty good at 74.67%. We don't want that to get much higher, though, for an actual company. And the last dividend payout for Duke Energy is $1.01 per share. They pay out quarterly, and that was paid out on March 16th. Let's take a look at their revenues really quick. What a strong amount of revenue for an energy company. My goodness. And by the way, this is in millions. So we're talking 22 million, 23 million, 24 million, 24, 22, 24, and then 28 million. So 2022 was a good year for them. You can see it it wants to keep going up, but it is a little bit flat through most of its revenue trail from 2013 to 2021. But a nice increase in 2022. And of course, combined with the fact that they continue to pay consistent dividends and grow their dividend rate is a great sign. Cash flow on the net income looks fine as well, although I would question the fact that even though their revenue went up in 2022, it looks like their net income went down from 21 to 22. So just something interesting to keep your eye on. But there's some mistakes you can make when it comes down to dividend investing. And even though we're talking about this month's dividend stocks that you can consider, there are mistakes that I see a lot of dividend investors fall prey to. And you want to make sure you don't make one of these 7 mistakes. And in order to make sure you don't do that, check out this video next. We'll see you on the next video.